Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of UK rate strategy, and I'm joined today by our global market specialists, Giles Gale and Nevruzi. Okay, Dan, I'm going to start with you because in what was, I guess, a quieter kind of data and central bank speak week, it felt like Powell's semi-annual testimony was really the highlight. Quieter in the sense of data and central bank speak hasn't necessarily meant quieter on the market. But nonetheless, let's start with Fed Chair Powell. So like I say, we had his semi-annual testimony in front of Congress this week, highly anticipated. Was it the kind of big fireworks that everyone was expecting?
As far as information delivered, Powell didn't really surprise all that much. It was more or less in line with our expectations, but it did have a hawkish lean. It's hard to deny it. Markets took it very, very hawkishly, in fact. So as context, the Federal Reserve Chair will start either in front of Senate or in front of the House, and it will, depending on the year, whether it falls on an odd or an even year. This year, the first semi-annual testimony started with the Senate, where historically, I should say, the toughest questions are generally asked. But it was really his prepared remarks that threw markets in kind of like in a little bit of a spin, because the key thing that was added and what market participants were looking to figure out was, well, is he going to comment on what was going to happen at the next meeting? Are we going to return back to 50 basis point hike increments given the strength in recent data? And what the statement added was that in assessing the totality of the data that's ahead of us, the Federal Reserve is prepared to adjust the pace of interest rate hikes higher if necessary, really. So that pretty much implies that, well, if data ahead of us comes strong, if we get strong jobs, strong payroll data on Friday, which I imagine at this time this podcast will be out, and also strong inflation next week, they might be willing to go back to 50 basis points. Fair enough, and that has been our expectation for even before we had the semi-annual testimony. On the other hand, the following day, the second day of his testimonies, the chair usually will read the same prepared remarks, but what he did was he kind of ad-libbed an extra statement in there saying, if the totality of the data, and I repeat, a decision has not been made on this yet, we might be willing to adjust. We are ready to adjust the pace of interest rate hikes. So he was very clear that don't think of 50 basis points is a done deal, but if it's needed, we will do it. Powell also pointed towards 4 key data releases that we should be looking out for. We already had one of them, the JOLTS job openings, which was slightly stronger than expectations, although showed a deceleration compared to the previous month, particularly in light of the higher revisions to the previous month. So it's trending in the right direction, but still a strong labor market. Powell also said, look out for the non-farm payroll numbers and unemployment numbers on Friday, and the CPI and PPI figures after that next week. So pretty much we have a good amount of data to look out for, but it will be almost like a binary bet in my mind that, well, if you have a strong inflation number, strong jobs, then yeah, they're going 50. If they show deceleration and January was an outlier, they're going 25.
So you mentioned there that we'd already revised up our Fed funds expectation to expect 50 basis points at the next meeting. How does this leave your view, I guess, for that meeting and beyond, or does it kind of leave it unchanged, I suppose, given everything that you said?
So we adjusted for 50 with that was right after the core PC data, which in our view gave them enough backing to justify even more. At this point, I don't even know if it's right calling it front loading, but sort of delivering the hikes as fast as possible, because we're not in the beginning of the hiking cycle by any means. But now we have 50 basis points for the March meeting, and then step back again down to 25, and 25 goes through June, which kind of puts you in the 5.5, 5.75 range, which end up actually being slightly lower. Well, after today's rally, maybe not so much, but kind of more or less in line with market, or just a little bit lower than market right now. But again, I think the key is that whether if it's 25 basis points above that or below that, the end of the rate hiking cycle is more or less visible. It's not like last June where we moved to 75 basis point increments and people had no idea whether we finished the cycle at 3.5, 4.5, 5.5, or 6.5. The outcome of distributions were so wide that it was just kind of hard to imagine. Then a forecast for terminal rate really could steer, or at least have like a very discernible path and implications for the economy. Now, if we end up at 5.5 or 5.75, in the grand scheme of things, it's not all that different unless you're a short-term money markets trader. Then, yeah, fair. That's your bread and butter. Otherwise, for implications for, let's just say, someone like a corporate borrower who goes in the market and raises 7-year debt, well, if they hike 25 basis points more in the 7-year point in rallies, then it was all, it doesn't make a difference for them. So 50 for next one and 25 basis points for 2 after.
Okay, that makes a lot of sense. So I guess when it comes to the Fed deciding whether they do 50 next month or not, next meeting, not next month, you mentioned a lot of key data points that Powell also kind of alluded to that we'll be getting over the next couple of weeks. What are your broad expectations, I suppose, for those data points? And as well, what would you place the most weight on? Clearly, if we get broad-based strength across all of them, then that will push the needle in the 50 basis point direction. But how do you see the Fed balancing the risks between, say, strong NFPs and weaker than expected CPI, or vice versa? What will be the real kicker for them, do you think?
We did the same exact exercise, just hypothetical scenarios where one of them is weak, the other one is strong, both are weak. And I think even though Powell pointed out towards the importance of payrolls, I think the hurdle on jobs has been passed. We don't need to see another above expectation read on NFPs for them to go 50. So let's just say a scenario like, and we have slightly below where the market is, but I should say the market view, or at least like the consensus estimates submitted to Bloomberg, are so wide that it's kind of hard to take that midpoint and say this is what the market expects. But let's just say an average run rate of 200,000. We are at 175, so slightly below. Seasonal effects definitely will play a role in dragging down NFPs down for this month, but we don't know exactly how much. So let's just say those are in trend, but CPI comes in 0.3 or 0.2 in core with actual weakness in core services. I think that justifies stepping down to 25. Even if we have, but on the other hand, if you have NFPs at 0, well below expectations, but then your CPI is at 0.5 in core with a strong, firmer services side, well, they might still go 50 because the hurdle on the employment side has been passed. We're not really trying to kind of reach a kind of like a fall below a certain level. Even if you take the 3-month average with a 0 number on tomorrow, by the time this is released, we will know it. So it might look ridiculous in my comments, but even if you take like an average rate over the 3 month, it will still be a very solid growth rate in employment. So it's really the CPI in my mind that matters the most, and taking these bets on what the Fed's going to do at the next meeting. And the Fed will be during their quiet period next week, so they won't be able to comment after CPI. So in my mind, it's a very binary bet on whether someone thinks the inflation number will be strong or weak for February.
All eyes on CPI then. And for any listener that's confused about our time frame of reference there, we are recording this on Thursday, so Jan is obviously talking about NFPs, which for us is tomorrow, not on payrolls. For us is tomorrow, but as he rightly says, probably by the time anybody gets around to listening to this, we will already have that number. So don't worry, Jan, if it was really wrong, we'll just edit that out. Okay, Jan, and let's move on to Europe then, because you've also been updating your Bund target there. I think when we caught up last week, we were probably
talking about it, weren't we? You were trying to wheedle it out of me, and
I was pushing a view out of you. And since we caught up last week, you have kind of stuck to your guns, revised up that Bund yield target at the 10-year point of the curve. So perhaps you can kind of just remind us what those key drivers are behind that higher target, and B, also just kind of update us on how that's been tracking this week.
Yeah, sure. I mean, listen, it's really very simple, and as promised last week, the revision was up and not down. The assessment was really, still a continuation of lots of themes, really, lots of bond supply. We've been saying for a while that we don't think that investors have the confidence or can have the confidence on inflation to really suck up that bond supply in the size that it's being thrown at. And as we go through the various issuer sort of classes and think about how their incentives might have changed, we don't really see a change in story anywhere. So obviously at some level the market clears, but I think that level is a bit of a moving target because, as we saw last year, then you get to levels where people think, oh, this is a great level. We haven't seen that in a while. I'll buy. So you have averages in, and you have pent up demand, and then people kind of go, well, all right, now I'll shift my ambitions a little bit, and so I think that's kind of what we're expecting. Also, the ECB, of course, so pricing for the peak rate and for the ECB has been steaming ahead, and is at levels which I think would be consistent with much, much higher long-term yields, not just slightly higher. And we throw all of that into a fair value model, which we've spoken about a few times on this podcast. And so that's supply and ECB pricing and all this, and then we kind of qualitatively overlay these other considerations. The model actually points towards levels. I'm not even going to say how high. I mean, much, much higher than here. And so I've shifted this to 3.25. That's the bottom line here, 3.25. And I think that's conservative. And one of the reasons that we have erred on the conservative side, even if a 50 basis point move from where we are now doesn't sound that conservative, is that I don't think that these sorts of levels at the front end are going to be sustained. So we've had to make some adjustment for the possibility of a correction there.
Okay, so let's think a little bit about the front end then, because I guess that has been in sort of laser focus this week, particularly, well, A, given the volatility, but B, ahead of the ECB next week. It doesn't feel like all that long ago we were just talking about the ECB and Fed and the BOE in their kind of February round of meeting. But here we are again, 1 week ahead of the ECB. What do you expect, or what are you looking for from them next week?
Well, I mean, the first thing is obviously a 50 basis point rate rise, but I think above all a bit of a shift in tone. Okay, and I think that this is really important to say. I've been looking a lot at the front end of all currencies really, and everything has been moving in with very, very tight correlation, and actually even similar levels of volatility with the US curve. And no, I don't think that that's right. I think that basically what's happening is that markets kind of revert to this assumption that everything should move in the same way until they're told differently. And obviously we have had a lot of US information, and the data sort of set that comes out every week is just that much thicker. And at the same time, we've been hearing lots from hawkish ECB speakers who I still think kind of, they're still talking as if they've just finished their December forecast round. But I think actually things have changed quite a bit. And so what we're really looking for next week is less forward guidance, more open forward guidance, an end to this strong indication that coming moves will be 50 basis points. And really that is the hurdle to doing anything else is really very high. And the key reason is that we think that the forecast round is going to be less inflationary. So remember, we had these big overshoots in inflation projected for coming years in the December round, and that was really what sort of started off the market to really shift their expectations for the ECB higher. Now, this year, this quarter, well, I mean, we do have slightly more resilient growth. I mean, a little bit of an uptick in growth, but still, growth is clearly on the weak. I mean, it's clearly weak. The fact that it's not necessarily a recession, even though it turns out that with the revisions it was slightly negative in Q4. Growth isn't a strong impetus, I would say, here to inflation. Compared to the last forecast round, the inflation figures, despite what you might have heard and read about, because people always seem to want to focus on these on the high numbers. So lots of comment on core inflation, for example, continuing to rise, but the actual outturns for Q1 have been lower than the ECB thought they were going to be back in December. Lower energy prices, much higher interest rates. The overall effect of fiscal response, which was supposed to be inflationary next year, because at lower energy prices have been what we've had over the winter, that fiscal effect will be much less. And then I guess that there's the discussion about wages, which are really the key risk at the moment. Maybe I should just add one other point, that I think that the ECB might be a little bit optimistic about the fact that expectation, at least professional expectations for inflation, have been starting to rein in. So market expectations have been going the other way, but more just recently with the Powell comments and so on, they've actually corrected back quite significantly. So we're actually looking, I think, compared to the market's expectations, for a slightly more dovish ECB. I think that's enough for me. I've waffled enough. Imogen, it's you. And you have been doing an awful lot of talking in the last...
That was my microphone and hearing we talk.
I think I only get it sort of in a second, and it's like passive smoking. But I think I could probably repeat your entire speech just by having listened to it on the other side of the corridor so many times. But look, you've been talking to lots and lots of clients ahead of the MPC and the budget, and maybe you could just give us your distillation of what you've heard from that.
Yes, well, firstly, I apologize, Giles, that you have to hear it again for the millionth time on this podcast. But I guess, yeah, like you say, we've been doing a kind of pre-MPC, pre-budget roadshow over the last week, or at least the last couple of days, with a combination of both hedge fund and real money clients. So a good kind of span of views, I would say. But I think there were two key themes that stuck out to me in terms of where we differed most from consensus amongst that client set. The first is around the MPC, and this probably comes as no surprise, particularly given, market pricing. I think as of now, the market's looking for a peak in bank rate of about 4.8% by September. So it's not that surprising for me to say that we were at the very dovish end of consensus on, of all the accounts that we spoke to. Their view, it wasn't a completely unanimous view, but the strong consensus was that the Bank of England were being much too complacent, particularly around the upside risks to wage inflation, and the tightness of the labour market, and that would kind of alleviate enough for them to take their foot off the gas by, a couple of meetings time, essentially. So there was definitely a strong consensus that they would keep hiking at a kind of steady pace through the rest of this year, particularly if we saw, more hawkish pressures from the Fed as well. And obviously a lot of the discussion after we heard from Fed Chair Powell this week, and also Catherine Mann, the BOE's kind of leading hawk, who was talking a lot about these kind of imported pressures in the UK of other countries having much more hawkish monetary policy settings. I guess our take on that would be that although we don't disagree that probably the risks, to our forecast are to the upside, and certainly they center around those kind of pressures on wage inflation, and that, where we have in our central scenario, average weekly earnings coming down to about 3.5% by the end of this year, the risks to that are skewed to the upside. And if anything is going to make the BOE need to hike more than we have in our central scenario, and a reminder for listeners that our central scenario is that they hike just once more to 4.25, but perhaps, with risks of them needing to hike again to 4.5. But if rates need to go higher than that, it will be driven by pressures on the wage inflation side. But we're not convinced that they will materialize, soon enough that would mean that the pause wouldn't be in, at least temporarily, this year. So it's much more likely that they hike to 4.25 or, perhaps even 4.5, but then actually pause for the rest of the year and wait to assess both, how persistent or otherwise the tightness in the labour market is, and then B, also these kind of lagged pass-through effects, particularly via the mortgage rate channel, and the resulting effect on demand and growth there, and what that means for inflation. And then perhaps have to resume hiking in 2024 if they need to. So we still think certainly near-term market pricing for the kind of meetings beyond May look quite stretched to us. The other kind of major pushback on the budget side, and I will say that the meetings were much more focused on the Bank of England and the MPC rather than the budget, although that changed a little bit latterly. We did a lot of meetings last week where I think people just hadn't quite thought about the budget yet, and therefore the focus was much more on the MPC. And obviously it has been, central banks that have been driving markets. So I wasn't necessarily surprised that people weren't that interested in the budget. But the part of that kind of budget view, I suppose, that got the most pushback was just around the skew of issuance and the fact that we expect the issuance to be very heavily skewed towards the short and medium buckets and away from the longs and the linkers. And I'm not sure that view in and of itself is particularly off consensus. I think that that's what everyone is expecting, really. But I just think that we had a much greater skew away from those buckets than the consensus had. We're talking about in kind of, notional terms and in sterling billion terms, the longs and the linker buckets being the same size next year as they were this year, which, although bigger gross gilt number, obviously represents a smaller slice of the pie.
Okay. And on the budget, interest has been starting to pick up. So other than the maturity split that you've just been through in detail, what else do you think in there might matter for gilts?
So I think for the overall kind of issuance number, away from that maturity split, like you say, there's really two key questions for gilts here. The first is the extent to which any fiscal headroom that the government has, and partly due to the public borrowing being much lower than expected this year. We've had a couple of data out there, and now we're 10 months into this fiscal year, and it suggests that public borrowing outturn will be lower than expected. And so to what extent is that fiscal headroom recycled next year? Our view is very much that it's a when, not an if. We're heading into a pre-election year, and we expect all of that fiscal headroom really to be recycled. The question is just the timing of that. Will the government want to announce all of their kind of pre-election fiscal giveaways next week, or would they rather save some of the kind of bigger fiscal fireworks until the autumn statement, or perhaps even to the spring budget next year, when we're much closer to that kind of campaigning period, I suppose, for the election, and they may well get a bit more kind of bang for their buck politically. That said, they're clearly very far behind in the polls right now, so I think there are going to have to be some fiscal giveaways next week, even if they save the bigger, more kind of vote-winning policies until later on in the year. So we're expecting a CGNCR number, which is the central government net cash requirement, and that's the number that kind of underpins gilt issuance number, the remit number. So that's the kind of key one that the markets watch out for. We're expecting that to be reduced by about 20 billion to 165. So that represents, like I say, about a 20 billion reduction versus what we would have expected after the autumn statement. And that reflects some of the fiscal headroom that has been created this year being recycled, but will look artificially lower versus what the outturn will eventually be once more of that fiscal headroom is recycled. On the second question, I said there's two key questions for gilt issuance. The second part of that is the extent to which the government can diversify their funding needs. So to alleviate some of the pressure on gilt yields by issuing all of this via gilt, can they do more via bills and via NS&I? Our view is that yes, they can do some via both of those, but I think it's very important not to overstate the downside risks to gilt issuance from both of those numbers. We already saw the bill stock rise to kind of record highs this year. They've already increased it by 30 billion or over 30 billion this year. So we pencil in another 20 billion increase, which will be, a sizable increase on the outstanding stock of bills. And the appetite to kind of increase that even further, given that they've already done a lot this year, I think might well be limited, especially as that issuance, just really gets turned out eventually into longer dated issuance anyway. And on NS&I, we pencil in 15 billion, which I think is the top end of a kind of realistic range, which might be more like 10 to 15 billion, to be honest with you. I think I've been through the views kind of in depth on this podcast, so I won't re-run through them, but I'm just skeptical that without a sufficiently more attractive savings product, the government will really be able to raise much more via NS&I than they have in previous years. And 10 to 11 billion was kind of the pre-COVID average. So that sounds like a reasonable range to me, but increasing it more than that in the kind of 40 billions is some numbers I've seen. I'm just skeptical as to the mechanism via which they're going to, be able to tap into retail savings and absorb that additional funding without new products that are significantly more attractive than what's already being offered by other savings products providers on the market.
Okay. And through all of this, obviously you've been listening as well as talking. I wonder if anything about your thinking on the markets as a whole.
I guess just given us greater conviction that the market is still mispriced, and
I'll rate you about to be.
Yeah, exactly. But I mean, to be honest with you, Giles, our market views are very much the same as you've already been through in Europe. We think that this supply-demand imbalance is really going to weigh. To put all those numbers that I just talked about on the budget together, what this really means is close to 290 billion of gross gilt and just less than 200 of net gilt, net of APF activity, net of Bank of England buying or selling. That's a huge amount of gilts for the market to absorb. That's more than triple the average kind of yearly net gilt issuance over the past decade. It's a huge regime shift when it comes to the supply outlook. And I still think that that's going to weigh pretty heavily on gilt yields going forwards. But just like you said, this isn't a kind of immediate impact. I'm not expecting necessarily the budget next week to be the kicker that drives gilt yields back up to 4.3%, as is our target, very quickly. I think that this is more of a gradual shift lower in the price of gilt and higher in yield as that clearing price that, is needed for the market to absorb all of these additional gilts that are coming on board just shifts lower and lower. So still bearish rates. I still think, especially given how we expect this queue of issuance to shift a bit shorter down the curve, that should weigh more on the belly than the long end. We've seen a lack of demand at the long end so far, but I do think if long end nominals and linkers are as scarce as we think they're going to be, relatively speaking, next year, that can bring about a bit more demand at the back end a bit sooner than we might otherwise have been expecting. And just going back to, what I was saying at the beginning about the MPC, I think that bank rate expectations have gone much too far. And whilst, yes, in our risk scenario, the bank might need to hike more, but that won't be until, further down the line. And I think that the front end has adjusted too far for that. So putting that together, we also like 2-10 steepness or being, expecting kind of underperformance of the 10-year part of the curve on a 2s, 10s, 30s line. Okay, that's more than enough from me. You've listened to me talk for too long and I've had to put you through that again. So I'm sorry, Giles. I'll be mute for the rest of the day. Right. Thank you both for joining me. And thank you to our listeners. Just a reminder that if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episode as soon as it's available. Thanks. See you next week.